Silver, I'm calling for it to run to 75 from here. So it's at, 29 to 75, and then back to at least back to here and probably back towards, the low 20s, mid 20s to low 20s. So that one's much more volatile. And then post bust, post bust, I think the precious metals are going to lead the pack. I mean, you will see, I think gold get to 20,000. So if it gets back to say 2,100 and then rallies to 20,000, almost tenfold move. And silver, I think, can get to 500. So, if it moves back to low 20s and moves to 500, you're talking about, a 25-fold move. So there's, I think, a huge future ahead in the precious metals.
Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated. Join our WhatsApp channel for real-time updates, breaking news, and expert predictions on gold, silver, and financial markets. Link in the description or pinned comment. Stay ahead of the curve. Don't miss out.
I don't think so. I mean, anything is possible, I guess. But if you look, even in 2008-9, it came back quickly, faster than the markets. But it did get hit initially, and I think that's what you can expect here. As I've said it, gold won't fall anywhere near as much as the equity market, in my opinion. Silver could. Silver's got more volatility to it, but gold, you probably see it down less and recover much sooner because the response to the bust will be massive money as well as massive fiscal response, government response, but that massive money response means people will probably take that as a signal that we got to get into gold again. So I'm kind of using it. I still think there's a big run in gold and silver here in the next 6 months. But I'm saying gold can get to 3,400 here before the bust, pre-bust, and then could fall back anywhere from its breakout point at 2,100 to mid 2,500. So if you do a calculus on that, it's basically saying it can fall by somewhere probably between 25 and 30%, something like that, which would be half or less, half or a third of what the equity market does. Silver, I'm calling for it to run to 75 from here. So it's at, 29 to at least back to here and probably back towards the low 20s, mid 20s to low 20s. So and then post bust, post bust, I think the precious metals are going to lead the pack. I mean, you will see, I think, gold get to, so if it gets back to say 2,100 and then rallies to 20,000, almost tenfold move. And silver, I think, can get to 500. So, if it moves back to low 20s and moves to 500, you're talking about, a 25-fold move. So there's, I think, a huge future ahead in the precious metals. They're, unlike the stock market, where I think the peak this next year, meaning that 7,500, if that's what it turns out to be on the S&P, the peak we see in this cycle is likely to stand for decades in terms of the indexes. There'll be opportunities within the indexes, lots of groups that will do well, commodity producers, et cetera. But the indexes, I think, because of much higher interest rates next cycle, you'll squeeze PE multiples, et cetera. So I don't think you'll revisit the highs of this next, probably see the highs in the first half of 2025, maybe even first quarter. Those highs probably won't be seen again this decade and maybe not next decade. Whereas with gold and silver, obviously, I'm talking about 20 plus fold increases in the metals, and obviously the miners will benefit greatly if that happens. I'm quite optimistic about what Trump is doing. He's coming in with a whole different understanding of Washington than he did back in 2016. He's hitting the ground running, assuming most or all of his nominees get confirmed, and I think his cabinet posts get the people he wants. I am optimistic that Doge will make some significant cuts in government, and that we'll see a much more efficient government, 2 and 3 years from now. The problem is the macro trumps that. I mean, I'm talking about something we haven't seen in 90 years. You can call the Great Depression part of it was a bust. We did see massive bank failures around the world. And we did see, an economy that was far below any recessionary norm. So you could call that what I'm calling here. This one isn't going to be a great depression. It's not stretched out over a decade because they will print that money pretty quickly. But the damage that's done in that 12 to 18-month time horizon that we're in a bust is massive. And it not only is bigger than anything Trump can offset with, it also really short circuits some of what if he were coming in a normal time, if this were even 4 years ago or 8 years ago, and he were doing this, I'd be super optimistic because it's a very pro-capitalist agenda with pretty big deregulation, drill baby drill. So taking advantage of the resources we have in this great land, and cutting government, trying to reduce government's influence on the economy, which is usually a drag. Doing all of that, I think, 8 years ago would have led to, basically what, people call the roaring 20s. I think you would have seen that. The problem is he's coming in at this time when we're approaching that bust. And yeah, he doesn't want to just print money like crazy, but that's what's going to happen. It's not because of Trump. It's not because of Powell. Every central bank is going to have no choice if they want to save the system. You can sit back and say, well, we're not blowing up, we're not going to pump the system up again like we did, and the mistakes we made last cycle. And that's what Powell's telling you, right? He's pretty adamant he's not going back to that QE solution again. That's easy to say until you're staring it in the face and the system is basically melting down. You're having a free fall in the financial system. They don't have a choice. It's the only tool they have where they can move quickly and stabilize the system. So whether it's 20 trillion or something less than that or more than that, that's my best guess of, kind of 4 times what we saw in the pandemic, and every central bank around the world doing the same thing. That's way past anything Trump can do at the margin, right? I mean, that blows you out of the water. We were a central bank balance sheet of 875 billion back in 2008 before the response to the financial crisis. 875 billion was the largest balance sheet we'd had going back to, was as big as we had gotten going back to 1913 when the Fed was put in place. And now we're talking, we got to 9 trillion during the pandemic, and we're talking maybe 30 trillion by the time we get through the bust.
That's what they want. They want a central bank digital currency. Or do we go back to constitutional sound money? Do they revalue gold? Do they have a Bitcoin strategic account and revalue gold and have assets that allow them to create a new monetary system based off of commodities with a marriage of blockchain technology? Maybe. I don't know that that'll happen, but what I do know will happen is that we are seeing more and more and more, de-dollarization, and they're moving in that direction. At least in terms of de-dollarization. The global net purchases by central banks reached 53 tons in November. That's the most in 14 months, and it's the 18th consecutive month that the central banks have purchased gold. That they have doubled in November their 12-month moving average. But certainly inflation, we all know what that should do for precious metals prices. Trump is even talking about putting tariffs on metal that comes into the United States, which this is one of the reasons you're seeing, again, this big spread between the exchange for physical price and the spot price, where if you have to exchange it for physical across the globe, it's going to be a whole lot more expensive right now, fearing these tariffs. In other words, if they wanted to buy a contract here and exchange it for physical and take it back to the United States, the premiums have blown out, because the fear is that once he takes office, he'll put tariffs on precious metals imports as well, which would push the price up tremendously. Inflation, obviously, the price should go much, much higher, and that's really what the whole premise of owning gold is. It's in silver. It's not that gold and silver are going higher. It's that the dollar is being inflated out from underneath us. I asked Judy Shelton the other day in my interview with her, I said, who came up with this boneheaded idea of a 2% mandate? Why not 0? Because with a 2% mandate in 10 years, you've lost 20%. I said, my father I'm sorry, this little dog is insane and she's all over the place. He graduated college in 1963. He was married at that point, my mother, and he said, I made $6,500 a year and I could live comfortably on that. Your mom and I could live comfortable on that in 1963. So, have things gotten that much more expensive, or has the dollar lost that much of its purchasing power? So when we look at you look at, imagine this was real. This is fake. It's a bank. But imagine a COMEX 100-ounce gold bar in 1974 when the exchange was founded. Gold was $42 an ounce. So, 42. It would have cost you for a 400-ounce gold bar like $14,000 to buy a 400-ounce gold bar in 1974. Well, what does it cost today? Is the price of gold go that much higher to where it's almost 1.1, $1.2 million? Or did the dollar lose that much of its purchasing power since 1974? My dad bought a Corvette in 1973 for $6,500, a Corvette Stingray. Now they're 116. The point of it is that over time, inflation is an insidious tax on your wealth. And so what gold does is it doesn't go higher. It retains its value in an inflationary environment. And everything Trump is talking about is inflationary, whether it be tariffs, which will mean higher prices to the consumer, or whether it be an inflationary policy, a weakened dollar, low interest rates. These all mean softer purchasing power. So I would say inflation is here, and you can see that the bond market sees that. That's why rates are going higher. And with all things being equal, even if they are able to trim $2 trillion off the deficit and off of the stupid spending of the government, that still leaves over a $1 trillion deficit every year. We're not addressing the root problem, and that is the fact that the deficit keeps adding to the debt. And, by 2031, 100% of income tax revenue, according to the Congressional Budget Office, goes to pay the interest on the debt and mandatory entitlements, which ironically are off balance sheet. Social Security and Medicaid and Medicare, he won't touch those. He already said that. So, inflation has to stay here because no one wants our treasuries at these rates. So if rates, and that means rates have to go higher. That hurts the economy. That hurts the banks. And if not, that means yield curve control. That means printing money out of thin air to buy bonds. That's Weimar Republic. That all leads to the same road. And, who knows when this all happens? They've been masterful at being able to keep the ball up in the air. But speaking, just speaking practically, at some point, the jig is up. So, yeah, for the people who are retiring right now, I don't know. I would be more concerned about their kids, people our age who, things may be a little bit different over the next 5-6 years. Yeah, there is certainly reason to be optimistic, but we're talking a long road to hoe to bring back manufacturing, to bring back the things that made this country great. And to get there, it's going to take maybe a reset. And short of that, a whole lot of debt restructuring, which is not going to be easy. It's going to be painful. So when I follow who's been buying gold, I look to the central banks. When I see what's going on in the stock market, I see the insiders selling at a 6-to-1 clip versus buying. In other words, corporate insiders are, for every one purchase, there's 6 sales. And you look at guys like Bezos, who sold 12.5 billion recently, Zuckerberg, who sold 2.5 billion worth of Meta. You look at the Nvidia insiders selling over 2 billion worth of sales. This is all year to date, but just between Zuckerberg and Bezos alone, you're at $15 billion sold. And, if the economy was roaring and we would expect the stock market to continue on this massive train moving forward, you wouldn't see that happening. And so as corporate execs are cashing out, individual investors aren't. That's a premise that I would start with, that I would be very nervous. I think we can look at the bond market, which in and of itself is getting nervous as inflation concerns are again reemerging, and they really never left. I mean, the Fed pivoted at 65-70% away from their lofty target rate. Was making a joke about this the other day. You're taking a cross-country trip from California to New York, and you stop in Omaha and say, we're there. We're 70% of the way there, but that's okay. That's good enough. And the point of it is that they haven't signaled victory on inflation. They've waved the white flag on it. And we can see that happening as the 10-year Treasury keeps going higher. In fact, the 20-year Treasury, which is something we really don't talk about very often, eclipsed 5% here just the other day. That's a big deal. That's a problem. We're getting into that point where the economy is going to start to shake and rattle, and we're seeing that with all of the longer duration maturities. And so, what does that mean for the economy? What does that mean for the bond market, for the ballooning U.S. debt? And what does it say about the flood of new Treasury securities that the government's going to have to sell? Who's going to buy them? Does that mean higher rates yet still? Are we in store for a yield curve control, which will again exacerbate inflation as we create money out of thin air by the Fed to buy the debt because no one else wants to buy the debt? And then you look at all of the metrics by which we gauge, are we heading into a recession, which would negatively impact stock portfolios and whatnot. And by every single metric and then some, we're there. The reinversion or the uninversion of the yield curve, the Claudia Sam rule, the increase in money market holdings, which is up to over $7 trillion. All of these things have accurately predicted recessions in the past. And so if I were at that point where I'm very quickly going to be receiving money out of my retirement, I would not have a problem with pivoting. I would not have a problem with selling all of those stocks in my IRA that I made a lofty profit on. Get the hell out of them, just like the big money is doing, before something happens that forces you to get out. Get out now, and I would layer it into incredibly short duration treasuries. As crazy as that sounds to me, I don't know where else you go where you can feel safe and sleep well at night in a market by every single metric is classically and historically overvalued, and the insiders are bailing ship, and the long end of the bond market moving higher, where the banks who bet again that wouldn't happen are going to be on the wrong side of that bet, especially if rates really start to move higher, which I expect that they will.
What are your thoughts on Andy Schectman's interview? Do you agree with his predictions? Do you think the BRICS nations could challenge the U.S. dollar and disrupt the American economy? Could gold really blow up in 2025? Drop your honest opinions in the comments and let the stacker community know if you're investing in miners or prefer sticking with physical metals. Thanks for watching. Don't forget to check out this video over here. I'm sure you'll enjoy it. I'll see you on the other side.